All right, we'll go ahead and get started now. Hello, everyone, and thank you for joining us for our 2023 Outlook for Endowments and Foundations. I'm Annie Deer, and I will be the moderator for today's presentation. Before we get started, I have a few quick housekeeping items to cover. If you have questions today, we encourage you to submit them throughout the discussion using the question box at the bottom of your screen. When we conclude today's prepared remarks, we will spend the remaining time answering any questions that have been submitted. And if we are unable to get to your question, we will personally follow up with you after the event. For your convenience, a recording of this event will be available on our website within the next several business days. Now, let me introduce today's speakers. Nick Centineo is a senior investment consultant, and his primary responsibilities include providing analytical support to institutional clients in the areas of objective setting, cash flow analysis, and asset allocation. Nick works directly with many nonprofits, giving him insight into trends, fundraising, and planning for endowments. Margaret Jeffries is a wealth management consultant, delivering a broad range of financial planning services to our clients. Margaret helps many clients who are also donors to develop strategies to meet their near and long-term charitable giving and tax and estate planning goals. Paul Stanzione is a portfolio strategist and is responsible for communicating Manning & Napier's philosophy, processes, and portfolio positioning. Paul has a focus on investments and understanding the markets so that you know how it affects your donors' portfolios as well as your organization's portfolio. Today's discussion will be split into three parts. First, we will recap how nonprofit organizations, donors, and the market were impacted in 2022. Next, we will provide our thoughts on what we expect to see in 2023 and beyond. And then we will wrap up with actionable ideas that your organization can utilize to ensure success going forward. To better understand where we're heading, it's important to recognize 2022's impact. Paul, can you kick us off and give us a recap of what we saw in the markets?
Yeah, thanks, Annie. Well, 2022 was certainly a year for the history books, though unfortunately not for many positive reasons. The year started off with the first quarter in several decades in which all asset classes, whether it be stocks, bonds, and all varieties thereof, really, were negative. There truly were no bright spots to be found across markets to start the year, and it was a very, very rare occurrence in that way. And then in the second quarter, it happened again. And then in the third quarter, it happened again. So 3 straight quarters in a row of this historic negative market environment for all asset classes. And we finally got some relief in the fourth quarter, but 2022 as a whole finished as a really tough year for stocks and as the worst year in modern recorded history for bonds. The biggest culprit of these challenging outcomes was really inflation. More specifically, it was the monetary policy response by the Federal Reserve to fight that inflation. It was really near impossible at the start of the year to see just how hot inflation would continue to run throughout 2022. So investors and the Fed were sort of all caught off guard with what ended up transpiring with inflation. At the beginning of the year, the Fed expected to hike interest rates modestly a couple of times, and that would be sort of sufficient to keep inflation in check throughout the year. But the inflation continued to defy expectations, and the Fed had to continue to become more and more aggressive throughout the year to try and cool off the economy and fight that inflation. Well, that's proven to be a pretty difficult job, to do that cooling of the economy and fighting of the inflation. Inflation has come down, to be sure, but other inflationary forces, sort of like the strength of the labor market and just how resilient the economy has been, have persisted throughout the last year plus. In fact, the unemployment rate actually finished 2022 lower than when it started the year, which has just been unbelievable in light of the aggressive campaign that the Fed launched against inflation to try to cool down the economy. So the labor market's been incredibly resilient, and it's really made the Fed's job that much more difficult in managing the inflationary environment, especially when you compound it with the difficulty that comes in measuring the real-time economic impact that monetary policy has, because it can have very lagged effects. So despite the gauntlet that 2022 presented, we have started to thankfully see some more positive signs emerge more recently. Markets have had a pretty positive start to 2023, though we certainly caution against taking that as any sort of an all clear signal at this point. And we'll talk more about sort of what we see moving forward potentially. Inflation has slowed down meaningfully, especially when it comes to physical goods and commodity prices. And because inflation has started to cooperate a little bit while the labor market has remained so strong and the economy has remained so strong in general, expectations for the economy have shifted a little bit recently, moving from previously sort of a almost near consensus that a recession is on the way, to maybe a bit more skepticism around that outcome. Here at Manning and Napier, we do continue to believe that an economic slowdown, likely resulting in some sort of recession, is more likely than not. However, it's certainly not a given, and it's definitely not guaranteed to be severe based on the economic resilience that we've seen so far.
It was obviously a very tumultuous year in the markets. And something else we should think about is the impact that such a year had on charitable giving. Nick, what trends are you seeing with charitable giving today?
Yeah, thanks, Annie. My comments are really predicated on the belief that donors are consumers, and like anything else, their financial health determines how much they consume and therefore their capacity to give. So it's really best to look at both longer term and shorter term trends to sort of assess the state of giving today. Longer term, demographics are a plus for fundraising, certainly. Our country continues to get older, and there will be a tremendous amount of wealth transferred over the next 20 years from older generations to either their heirs or the organizations they care about. People also have a much better understanding of estate planning options than prior generations have had, which makes us believe that they're going to look for smart ways to pass on their assets. Shorter term, the jobs picture today is probably a plus, but there is also uncertainty for what the future holds, as Paul mentioned. Stock and bond markets are a negative today. There's a close relationship between the markets and charitable giving, usually with a bit of a lag to it. And last year was not a good year for returns, as you know, broadly speaking, and this could give many donors second thoughts about their financial situation. Inflation is a negative. Inflation is really difficult for people's finances because it's highly visible. Whenever you go to the grocery store, you see it, and it's also not something that's easily controlled. So inflation has definitely put a damper, I think, on people's confidence to spend or to donate. And then, the last important factor, I think, is income. Lots of smaller gifts are made from a donor's current income as opposed to their assets. I think you have to call this factor kind of a push, maybe a split between a pro and a plus and a negative, because there's some unusual things, I think, going on with people's wages today. Lower income households traditionally don't fare as well during a downturn or when inflation is high. But over the last several years, their wage growth has actually exceeded that of higher income households. The numbers are that 42%, there's been 42% income growth for the bottom fourth of households since 2019. versus only 20% income growth for the top fourth of households. Lower income workers tend to work in industries that are kind of hurting for people right now. You read about the shortage of workers in maybe transportation or retail, for example, but compare that to technology, that they employ a higher share of white collar workers, and those industries have announced layoffs recently, Facebook, Google, and Twitter, and so forth. So as this downturn progresses, we might see this change, but know that higher income households, they still hold much more in savings and investments on an absolute basis. But there are some unusual dynamics at play here that I think fundraisers should really be aware of.
Margaret, since you work directly with investors and individuals on planning, what are you seeing with your clients? Are they building charitable giving into their plans, or do you find that they are pulling back a little bit?
So I actually do find that our charitably inclined donors or clients will give. So they already want to give, they're going to continue to give. But how they give and the timing they give may be changing. Or, we like to say you need to be dynamic or flexible in that timing. So we want to make sure, as Nick said, their plan is solid first. We want to look at where do they stand today. And this is especially important for retirees that, are living off of a fixed bucket of assets at this point, a fixed income, which may be a Social Security, a pension. So we just want to make sure that they're all set themselves. So what this means is that those smaller gifts, maybe like $1,000, to your local church or something like that, those are probably still going to happen. But we're kind of saying, oh, maybe you want to wait to make a larger lifetime gift, or maybe even change it for those that are older into a bequest in a trust or a will that will occur at death. So there's a little bit of difference, but I do think those smaller annual gifts, as Nick said, are more sticky.
Shifting gears a bit as we start to look ahead, Nick had mentioned that inflation has played a role in the financial confidence of donors. So where do we think inflation will go from here?
Yeah, the high level short answer really is that we've likely gone through the worst of it and are currently emerging out the other side with inflation coming down. Since inflation can be measured in a variety of different ways, there's plenty of debate out there right now surrounding sort of the speed and magnitude at which inflation is actually slowing. But one thing does appear to be pretty consistent, and that is that inflation is slowing, and it's slowing down pretty meaningfully. To put a little bit of context around that, if we look at a couple of the most widely cited measures of inflation, the CPI and the PCE, that are both measured a little bit differently, but generally considered to be sort of pretty all-encompassing measures of the price level and inflation. They've come down to a point in the last in recent months to a point where if the actual inflation over the last 3 months of 2022 were compounded out to a hypothetical full year inflation number, inflation would actually be sitting in the 2 to 3% range, which is a whole lot lower than the 5 to 6% range that the annual numbers are still reflecting, because they're inclusive of monthly data from earlier in 2022. So the most recent monthly inflation numbers have been quite encouraging from that perspective in terms of inflation really coming down. But if you dig into the inflation itself, goods inflation is falling quickly. However, services inflation does continue to rise in most instances. It makes sense because prices for services tend to be a little bit more sticky and a little bit less volatile. So kind of slower to move in either direction, but also generally reported on more of a lagged basis, especially when it comes to housing prices, whether that be purchases or rents. So the trends that we're seeing in service prices are really always going to be lagging behind what we see in goods prices, which is definitely important to keep in mind when you're looking at the overall direction of inflation. Regarding sort of those various sources, we do appear to be at a point where the acute inflation risk does not appear to be the primary risk on the horizon right now, which is great. But there does remain a question out there about sort of the longer term and where inflation might end up settling in for the next several years, looking further out than the immediate term right in front of us. Depending on the path forward for monetary policy and for interest rates, there does remain that potential for sort of an extended regime, if you will, of higher inflation than really what we became accustomed to over the last couple of decades, which was a very low inflationary environment. Nick will talk a little bit more later about some of the potential implications of a elevated inflationary regime, but the possible drivers of this sort of longer for higher inflation are really things that we've had our eyes on since even before the pandemic started in 2020. Things like a rise in more populist preferences around the world at the expense of sort of more globalism, a related desire for sort of nearshoring or reshoring of jobs in a lot of circumstances, and making supply chains less global and more domestic, as well as just sort of a general underinvestment over the past decade or so in production of whether it be industrial goods, commodities, infrastructure, and other economic needs over recent years. So ultimately, we believe confidently that inflation is improving and continues to improve from a near-term perspective, but there are several longer-term factors that we're continuing to monitor in regard to the possibility of sort of sustained higher inflation over the long term.
And Paul, now the big question on all of our minds is, does this mean we are headed for a recession?
Yeah, that is kind of the other elephant in the room right now, in addition to inflation, is this idea of a recession. And the short answer to the direct question, in our view, is yes, probably. The long answer certainly adds a lot more nuance to that, and that yes or no outcome sort of comes with a lot of caveats in terms of magnitude, potential duration of a slowdown, and really how widespread it could be across the economy. So if a recession does occur, and how much and how likely that is, it's likely to be a direct function of how steadfast really the Federal Reserve remains in raising interest rates to fight inflation and or keeping interest rates elevated, and really for how long they retain their conviction in doing that. The longer that interest rates go up and remain elevated, the more spending and investment is discouraged throughout the economy. So that's sort of the idea of raising interest rates, and therefore the likelihood of rising unemployment and a slowdown in the labor market increases. It's important to note at this point that the economy, by many measures, continues to appear really, really strong. Unemployment is still at a record low. Jobs continue to be added in large numbers right through the most recent data that we have through the end of the year, and wages have generally remained strong as well. With that said, we have started to see some certain pockets of weakness, though, throughout the economy. That includes layoffs in specific sectors of the economy, housing prices beginning to creep downward a bit, and companies in some sectors of the economy beginning to indicate expectations for a slowdown in their growth and in their profits. Like I said earlier, this has not been sort of a widespread weakness yet, but we do remain of the opinion that we will likely continue to see further weakening in the economy and in jobs from where we are right now. And that will likely come as sort of the lagged effects of the restrictive monetary policy that's been in place for the past year, continues, and limited fiscal support continues as well. And those things make their way into the real economy. So ultimately, whether a recession comes to pass or not isn't necessarily the most important question to ponder or to ask. Rather, we really want to be asking and monitoring what that recession could actually look like, what impact it could have on jobs and national income, what it could mean for investment markets, whether it be stocks or fixed income, and really any other potential impacts on nonprofits specifically when it comes to what a recession could mean. So those are really the things that we're keeping a close eye on from here.
As we anticipate an economic slowdown and the potential impact it can have on jobs, income, and investment markets, what kind of risks are nonprofit investors facing today?
Yeah, Paul, I think that's a good recap. I'll try to give a little bit of background, I think, on why that matters. I think the three core assumptions that we usually use when we're creating a plan for an endowment or foundation are their withdrawal levels, their portfolio returns, and inflation. And in the case of an endowment, for example, if you have a good handle on these three things, you can set up a portfolio that should be able to balance the need to fund withdrawals and the need to reinvest to maintain its purchasing power over the long term. So we can start by talking about inflation. So even if the Fed is able to get a good handle on it over the next 2 years, there is this meaningful risk out there that inflation over the longer term will be higher than it's been in the recent past. And Paul's outlined some of the factors pointing to this. They really all center, to me, they really all center around wages. That if there is lower structural unemployment in the future and companies continue to have trouble finding workers, then those workers can extract higher wages. They can change their expectations for what is a reasonable wage and what is a reasonable annual raise. And then that can eventually lead to higher costs for companies and higher prices. So the break-even inflation rate, that's the difference between yields on inflation-adjusted bonds and nominal bonds. That's about at 2.25% today on 10-year bonds. So 2.25%, that's the market's consensus on inflation over the next 10 years. That's down from about 3% last spring, but it's up from, it was less than 1% during the panic of 2020. So there's been quite a swing over the past few years as far as inflation expectations go. The market it's often wrong about these sort of things. But our base case is that 2.25% inflation, it is a good starting point for planning today, but there's a high risk of inflation surprising on the upside. And even a 1 or 2% difference can cause big challenges for nonprofit portfolios. So create a base plan and test for the impact of potentially higher long-term inflation on that plan. That's our recommendation for today. Now, number 2, investment returns. That's another key assumption, and certainly a meaningful risk today remains that returns could be lower than average going forward for the market as a whole. Bonds are usually the easiest to predict. The good news is that yields are meaningfully higher today, and there's been lots written about kind of the return of bonds and investors finally having an alternative, finally having an alternative to the stock market. And that's true to an extent, except that when you look at 10-year treasury yields, to take an example, they're still below their long-term average today. So it says something, when rates have risen as far as they have, but we're still not even back to average yet. Future returns for stocks are much harder to predict, but generally speaking, investors can look at forecasted earnings and the valuation multiple that they're willing to pay for those earnings to get a broad sense of the future. Paul's outlined how company earnings and really the economy as a whole is really under a cloud of uncertainty right now. It doesn't mean there is an opportunity, but a slowdown of some degree is expected. At the same time, the multiple that investors place on those earnings, it's starting at a pretty high level today. You can look at this number you can look at this in a number of different ways, but multiples have come down over the past year. And by one measure, we like to use the cyclically adjusted PE, the price to earnings. We still remain at a point where the only time stocks have ever been more expensive was during the 2000 tech wreck. So in total, stocks remain expensive by historical standards, which is going to be a headwind for future returns. So our base case on the market returns assumption is that investors really need to be prepared for lower returns in the future. Although as an active manager, we're doing all we can to counteract these headwinds. And then finally, I did want to mention, there's the risk that your portfolio fails to reflect shifting opportunities. And what do we mean by that? There's been tremendous change in the past year. The biggest example of that is rising interest rates. But there's also been change in terms of the types of stocks leading the market, the types of industries that investors are favoring, and then certainly the economic outlook. We've gone from go-go growth to most investors expecting a slowdown. For some, portfolio allocations have a way of being too sticky. They may not change over time to reflect the opportunities or the risks that are in the market today. Some investors have a bad habit of fighting the last war. They look at what's been successful in the past, but they fail to factor in the future. And because markets shift rapidly, a big risk today is that investors just fail to reflect these shifts in how they position their portfolio. And so this is all predicated on the belief that the best predictor of the future is not what's happened in the past, but what the environment today is indicating. And having the flexibility and taking advantage of it will be a big determinant for whether nonprofits can meet their goals.
Margaret, given the state of uncertainty that we're currently in and the effect that such a state has on planning, what giving strategies are going to be the most effective for donors today?
Sure. So in the market run up that we've seen over the past, couple decades almost, we've seen clients donating highly appreciated stocks directly to the charity. But now those stocks may be at a lower value or even at a loss. In this case, we now suggest the donor sell the stock, especially if it's at a loss, so that they can take the loss from income and then donate the cash. So donations are generally going to be made more in cash than in-kind stocks, as we may have seen leading up to last year and this year. Another option, especially with the changes with the Secure Act for IRAs, instead of leaving a bequest in a will of after-tax dollars, naming the charity as a beneficiary of an IRA. Charities do not pay taxes on IRA balances that they are gifted. And if you leave after-tax dollars to heirs, to individuals, children, then they don't have to pay taxes on those IRA dollars either. This means no one pays taxes on those pre-tax IRA dollars that are left to charities. Another option that's always been available, but this year may be more favorable, are charitable remainder trusts. Charitable remainder trusts, when funded, the donor gets an upfront charitable deduction from income. But that how much of the donation to the charitable remainder trust depends on interest rates. The lower the interest rates, the less they get to deduct of the balance. The higher the interest rates, the more they get to deduct. So with interest rates higher than they've been in several years, these are now more favorable than they've been. And there's actually another opportunity created by the Secure Act 2.0, which was passed in the last couple of years. Now charitable remainder trusts can be funded with up to $50,000 from an IRA or with a qualified charitable distribution or QCD. And this is up to $50,000 per IRA owner, so $100,000 per couple. It's a one-time gift, but because a qualified charitable distribution is completely tax-free, it's not an itemized deduction. This is like a permanent benefit to fund a charitable remainder trust because interest rates have no impact on the tax deductibility of funding a CRT with a QCD. And QCDs can also fund charitable gift annuities as well. And just one last thing on QCDs, they can be made at age 70 and a half, regardless of when RMDs start. So that's about 2.5 years, 3 years earlier than RMDs start. And we do see donors forget that, so I like to remind people.
Now that we've established where we've gone and where we see things heading, we have some actionable ways that organizations can set themselves up for success going forward. One of the first steps here is to set clear goals for the year ahead. Nick, how can organizations stay on track when it comes to meeting these goals?
Yeah, so now you know what to be on the lookout for when you're reevaluating your policies, say your investment policy or your spending policy. So I'd ask yourself these 3 questions. Do we have the tools to manage potentially higher inflation? Again, it's not a given, but it's plausible to think that inflation will be higher over the next 10 years than it has been over the previous 10. And if it is, and if your portfolio has a goal to maintain its purchasing power, as most true endowed portfolios do, then you have 3 primary tools. You can spend less, you can take more market risk in your portfolio, really seeking higher returns that way through stocks, for example. Or you can position your portfolio to actively manage this risk. Certain companies or asset classes can be winners or losers, depending on how inflation shakes out. So those are 3 good tools that nonprofits can use. Does our allocation reflect our portfolio's intended balance between growth and preservation? Getting this balance right is the #1 decision on your plate because it does the most to impact your success. So your time horizon, your risk tolerance, and your withdrawal needs are what to evaluate. So take a good hard look at these fundamental aspects of your portfolio and see if your policy might need to be changed to meet them. And after the changes that have happened in the past few years, it's definitely possible your guidelines or allocations may need to change as well. So keep an eye out for that. And then lastly, is our investment advisor capable of delivering the results we need? I mentioned before about a big risk today being the failure to adjust to your portfolio to reflect changing conditions. For most organizations, that's not the board or the committee's job. They set the investment policy, but they don't adjust the portfolio day to day. That's your advisors or your investment manager's job. And we would suggest assessing whether they have the flexibility to do this, whether they can change with the market. Is their process for doing this prudent? Does it make sense fundamentally? And then finally, looking at their track record. Have they successfully navigated a range of different markets in the past? And do you think they can continue to do that? These are all crucial questions I think you can be asking your advisor today.
Sticking with the theme of investments, another important question to address is how should organizations position their portfolio today?
Well, as Nick just alluded to, the true proactive flexibility really is paramount when positioning portfolios through various and changing and challenging market conditions. To again echo the key distinction that Nick made, though, is that when we talk about the importance of flexibility, it's not about constantly moving the goalposts or changing an overall strategy in the face of volatility, but rather it's really having the flexibility to identify areas of opportunity and to avoid areas of risk within the bounds of the investor or the organization's sort of well-defined long-term goals and objectives. Speaking more specifically to that concept of flexibility within consistent objectives, we're doing a few things of note, I would say, here at Manning and Napier right now, within client portfolios to try and address the current environment. We've been looking to limit risk exposure in portfolios through a relatively more defensive posture when it comes to asset allocation and decreasing exposure to stocks broadly. We're maintaining exposure to what we view as high quality businesses that we believe really are most likely to be the most resilient through a potential recession or economic slowdown. And at the same time, we're diligently preparing to take advantage of new opportunities that are likely to be presented if those recessionary conditions do come to pass. We're managing through the fixed income market environment in a similarly active way as well, trying to keep risk exposures relatively limited, gradually taking advantage of the opportunities that are presented, whether it be from an interest rate perspective or sort of a credit perspective within fixed income. The silver lining in what was a very painful 2022 for bond investors is that pain has begotten a current interest rate environment that is much more attractive for fixed income investors than really has existed in a very long time. So being able to lean on those higher interest rates now that investors can earn on bonds really across the maturity spectrum is a huge benefit to a diversified, objectives, goals-based portfolio, especially when there remains a certain degree of trepidation about the economy and equity markets as well.
We've established the challenging marketing conditions that are ongoing at this time. So what are some of the most effective ways for organizations to reach their donors today?
Yeah, I'll go first, and Margaret, I'd like to hear your answer too. But regarding capacity, every donor is different. But we've talked about how in aggregate there's headwinds to capacity today. The market's down, inflation is high, and the economy is uncertain. Wealthy people will generally be fine, but for some, all these headwinds could give them pause before committing to a big gift. I can't say whether this is enough to change something drastically at your organization. What I can recommend is to be mindful of headwinds to capacity today, and to be able to pivot to a plan B if you have to. If you were planning on making an ask to a major donor, for instance, but you determine now is just the wrong time, being able to pivot to your cultivation and your stewardship strategies instead, that'll buy yourself time and retain goodwill. So that's a good option to have available. And then regarding planned giving and endowed giving, this has been a recommendation of ours for a while. I'm sure you've heard me talk about it before, just because the secular trends are just so attractive. Again, an aging population and more knowledge about planning techniques, and just a tremendous amount of wealth that'll be changing hands over the next 20 years. Baby boomers are likely the wealthiest generation ever, proportionally. And your organization can and should be focusing on how to attract them to your cause. And because of this, it just remains a great time to invest in the infrastructure of planned gifts. And I'm thinking marketing collateral, websites, social media events, networking with donors' advisors, and then if possible, hiring staff with a focus on planned gifts. I think all those things will be good investments in fundraising going forward. So Margaret, what do you think?
No, and I agree with everything. And I also think that ongoing communication is key. I don't know how many times a client or donor has told me, oh, I didn't even know that I had this option. Like, I didn't know I could donate my IRA and it was completely tax-free. And I also feel like it's the same person that I told last year about the same exact thing. So I just think, open lines of communication and reminders are really important. Specifically right now, you could remind donors about donating IRA assets or making a QCD because they probably are setting up their withdrawals right now or something like that. So just sending out emails, letting them know about changes in legislation, like this new option to fund a CRTA, for example. And keeping open line of communication. And I personally also love doing educational things. So there's lots of resources out there to help you be able to educate your donors.
Well, this marks the end of all of our prepared remarks today. If you have any specific questions for our panelists, feel free to add them into the Q&A, or you can reach out to us directly. We have also included a link to a survey in the chat and appreciate any feedback you have about our speakers or the content of the webinar. The survey will also automatically pop up for you at the conclusion of today's presentation. So at this time, we can begin answering some of the questions that have come in. Nick, I'm going to send this first one to you. Is a 60-40 portfolio allocation still appropriate for nonprofits?
Yeah, this is a question that's come up today because of how badly 60-40 kind of failed last year. Bonds are supposed to counteract the volatility in the stock market, and it just didn't happen last year. I think there's arguments for and against this approach. I think today it's a good starting point for a portfolio because it helps generally find the right balance between growth and preservation and income. And that's important. And 60-40 is about neutral. I actually like 70-30 a little more because for endowments, it's been a little bit more successful. But the concept is the same. Finding a good neutral portfolio to build off of that over the long term has been successful. And on the plus side, much of the pain may already be over in the bond market. Rates are way more attractive now. So you'd have to think about that. You'd have to think that bonds will continue to be a poor protector, even though they can earn more income today. So that would have to be the argument. The best argument, another argument against, is probably that bonds have been in a bull market for the past 40 years, and now maybe that cycle has ended. In fits and starts, rates have been falling since the 80s when they were in the double digits, and it's unlikely that this can continue. And so I think for some investors do argue that this is a real fundamental shift in the long-term usefulness of bonds, and that'll impact how a 60-40 portfolio is used. I do think that both these arguments miss the bigger picture, that 60-40 has never been a total solution. It's averaged about 8% returns, which is a good target for many nonprofits on average, but it's failed to hit that average about half the time. Thus the definition of an average. So and it's even over periods as long as 20 years, you could go earning lower than 8% returns, which doesn't do your organization any favors. So that's really why our approach at Manning uses a range of different allocations instead of a single target, because there's times when you'll want to earn more, you'll want to own more or less of any given asset class. And our recommendation is to have the flexibility baked into your process for doing that. But 60-40 or 70-30, it's a good starting point. Just have the flexibility to deviate from that, depending on what the market is like today.
Nick, I'm actually going to send this second question to you as well. Should capital campaigns be postponed given the current environment, or is now the time to go for it?
Donor capacity is likely down this year. I can't say whether you should delay a campaign or not. There's a lot of particulars that are important to consider. You all know your donor base better than I do, your geography, your case for support. I think all that tends to override most big picture economic factors. But there seem to be headwinds that weren't there a year ago. So that's certainly something to factor in. Just about the worst, just about the worst thing you could do is go public with a campaign and then fail to reach your goal, right? And so the rule of thumb that most use is to wait until you have about 60 or 70% of the money pledged before you go public. You could wait until you're at the higher end of that, building yourself in that cushion. Your lead donors are partners in most campaigns, right? So they're already invested in seeing you succeed. And so you could ask them, you could see if they're willing to cover any shortfall that might occur, or buy yourself a little bit of risk management in that way using your lead donors. And then if you did a feasibility study, maybe there's room as a follow-up to that, or as part of a focus group to test the question of sort of the timing of when it makes sense to go public or take on a capital campaign. There's no there's no guarantee that things won't get worse either. So it's always really hard to time these things perfectly. And so I think the best thing is to control what you can, just really have a strong case for support. And that should be the biggest focus, I think, for most campaigns. Hope that helps.
Paul, I'm going to hand this next one off to you. It appears to me that a high percentage of the Inflation Reduction Act, the CHIP Act, and the Infrastructure Act has not yet been spent. So won't this continued massive federal spending fight what the Fed is trying to do, thus dragging out the raising of interest rates?
Yeah, that's a great question, and really sort of speaks to the nuance that's in place when it comes to sort of the balance of fiscal and monetary policy, and trying to the government and the Federal Reserve's role in sort of stimulating versus controlling the economy and keeping inflation in check. I would say the biggest key to answering that question is the idea that even with sort of the expected government spending over the next several years, whether in the form of infrastructure spending through that legislation or otherwise, is expected to be a fraction of the amount of government spending that occurred in 2020 and 2021, primarily in the form of the sort of direct payments made to citizens and the direct injection of liquidity and cash into the economy. So that's really important distinction, that we do expect money to be spent, but to the extent that inflation, that a lot of the inflation that the Fed is fighting right now has been caused to some degree or another by the degree of liquidity and money injected into the economy over the last couple of years, notably 2020 and 2021. That's not likely to have nearly the impact from a fiscal policy perspective in terms of driving inflation to a large degree, because the dollar amounts are simply expected to be a lot smaller in the grand scheme of things, relative to what they were in 2020 and 2021. It's also important to consider sort of the use of the government spending that is expected to occur, and the productivity of those dollars. So to the extent that, again, using the infrastructure sort of spending as an example, to the extent that money is spent in a productive way, generating jobs, generating economic production, and sort of, in theory, expanding the economy from a real capacity perspective, that's another factor that makes it less likely for sort of that level of government spending per se to have a real significant inflationary impact. So all that said, those are a few things that we see and that give us a certain degree of solace in the idea that, like we talked about during the presentation, we could potentially be heading toward a longer term elevated inflationary period, but that's not likely to look anything like the inflation that we experienced in 2022 in terms of the magnitude of it. And we don't think that the degree and the nature of the expected government spending from that various legislation in the coming years is likely to result in sort of another sort of acute round of an inflationary crisis environment, if you will.
All right, it looks like we have one last question. Nick, I'm going to shoot this back over to you. Does wage growth for lower income households mean that organizations should increase their fundraising outreach efforts with donors in that demographic? Is it a long-term trend that justifies permanent strategy changes?
I'm a big believer in having a diversified approach to donors. So having something for everyone, essentially, but having an approach that allows for smaller gifts to then be cultivated and steward into larger major gifts, to then be cultivated and steward into potential planned gifts and estate gifts. Having a good robust annual fund, for example, gives lower income people a chance to participate in your organization. But it also does encourage their long-term participation, their long-term investment, if they're able to continue that support over the long term. I don't think that anything that's happening on year to year in how wages changes. I don't think any of that changes the core strategy of that approach, which is again to move people through the process, through the gift giving process of initial investment to little greater investment and cultivation, and eventually into a capstone lifetime gift. So that's always been my default for how to approach different types of givers, different income levels, different demographics.
Well, that wraps up the last of our submitted questions for today. But if you have any additional questions about anything we discussed today, please don't hesitate to contact us and we will get back to you within a few business days. As I mentioned earlier, a recording of this event will be available on our website within the next several business days. As a reminder, our Endowments and Foundations team is here to help you and your organization achieve your goals. We can help with portfolio evaluations, investment policy statements, and provide education for your board and staff, just to name a few things. We also publish monthly blog posts, host quarterly webinars, and provide other thought leadership on our Insights for Nonprofit site. So if you're not already subscribed, feel free to sign up to receive these complimentary resources. We have links provided right here on this slide and in the chat as well. Thank you so much again to our speakers, Nick, Margaret, and Paul, and thank you all for attending. Have a wonderful rest of your day.
Thanks, everyone.